Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Welcome, everyone, to this month's edition of our AWA Market Minute. We're super excited to have our audience with us today. Scott, why don't we go ahead and dive into the financial headlines?
Sounds good.
Well, out of the gate, this has been a busy week. We've seen quite a bit of big events that are taking place. Right now, we're obviously in the midst of the Republican National Convention. Last week, there was an assassination attempt on former President Donald Trump. This week, we heard about the vice presidential nominee being selected and announced. A lot going on, and our job as investment advisors and helping our clients through the retirement is not to be political, but to try to help people understand how the political arena does, in fact, impact some of the financial world and draw conclusions there to make sure that we're protecting and being aware of, what things are happening that could potentially impact our retirement investments and accounts. So on this subject, a number of interesting things are taking place with this kind of energy and momentum that's happening in the with the Donald Trump campaign. The first thing is we're seeing the Trump media and technology group having some significant some boosts in their share value. The parent company, Truth Social, there was an IPO back in March, and it listed at $70 a share. By June, it was down to like $13 a share. We're seeing all of that increase significantly, in that Trump media technology group just on Monday alone was up 31%. That particular share. We're seeing other interesting movements. Tesla, for example, is seeing kind of a bump through all of this, and many people speculate that is, Elon Musk concerned about Chinese tariffs, cuts in EV credits, and their hope would be that with momentum happening for the Republican campaign right now, that some of those things, the regulatory environments will be kind of backed off a little bit.
Yeah, it's kind of interesting with Trump's economic policies and also kind of J.D. Vance's economic philosophy. This is fairly atypical relative to historic Republican kind of free trade type philosophy. J.D. Vance in particular, very protectionist in nature, very pro-union. So it is a little different spin on kind of Republican economic policy. So it will be interesting to see how that materializes.
Yeah, and even things like Bitcoin and cryptocurrencies, they're enjoying a little bit of a bump right now. I think the same conversation, their hope is that there'll be a softened regulatory environment in that space. Trump has kind of positioned himself as the champion of that cryptocurrency space. So interesting to see how this all plays out.
Yeah, and another thing we're seeing of note is of late is the direction of interest rates and kind of where the Federal Reserve's head is at. And historically speaking, the target for inflation for the Federal Reserve is 2% inflation. We're still well north of that. But Jerome Powell, the Fed chairman, has indicated, hey, they might not necessarily wait until we're at 2% to start cutting rates. And right now, futures contracts suggest we'll have a rate cut sometime this year, back half of the year, and then a couple rate cuts potentially in 2025. And interest rate cuts are typically a good tailwind for stocks. Interest rate cuts are also typically a good tailwind for bonds.
Yeah, I mean, what I read recently was a 93% probability now that they're going to see a rate cut by September. Obviously, nobody has that crystal ball readily available, but that is clearly where the momentum is kind of going. And I think even Jerome Powell, when he spoke last week, had a hard time holding back some of the optimism that they're sensing right now. And everybody reads every word and tries to pick apart every emotion that he might be expressing. But I think there was generally a sense of optimism that they're finally turning the corner on some of these interest rate problems.
Yeah, you think about Jay Powell and how would it be to wake up every morning and have the fear that every single word you speak is going to be dissected by, hundreds of analysts.
Yeah, and then people try to not just dissect it, but act on that information as if there's something to glean from the way he said something.
Yeah.
Finally, the headline here is Google is in the middle of trying to purchase a cybersecurity business called Wiz, and a $23 billion deal. And Wiz kind of plays in that cloud cybersecurity space. Google's clearly signaling that they're trying to make a heavy investment in this space. This would be the largest acquisition for Google to date.
Yeah, and it's interesting with these big tech companies, they are generating new ideas and new businesses internally. But a lot of times when there's a competitor that has a business model they like, they just buy them up. They have enough cash and big enough war chests where this isn't atypical, although to your point, Paul, this is the largest that we've seen.
So a couple others that they purchased, just to kind of put this into perspective, Google purchased Motorola in 2012 for half this price tag, $12.5 billion. I think one of the most fascinating ones was in 2006, Google purchased YouTube for $1.65 billion. Now, today, the estimated value of YouTube, we looked this up, was roughly $400 billion. That's a pretty good return on investment, Scott.
Yeah, no kidding. And I think, Google and a lot of these big tech companies will take a flyer on some businesses, and they're large enough where they can take a flyer on several. And for every YouTube that pops, there's several that maybe don't. But when they do hit a home run, it covers the cost of some of those other gambles that they maybe make.
Absolutely. Now, obviously, this still has to go through the antitrust kind of scrutiny process, and that doesn't mean it's going to happen because last year we saw Adobe make a play for Figma, and that got busted up through some of those litigation processes. So,
in terms of how markets have been doing, it has been a good year for markets. The NASDAQ is up 22%. Tech heavy and tech names have done particularly well. The S&P is increasingly very tech heavy. It's up about 18%. The Dow is up more modestly, much more modestly, in fact, at just over 8%. And then on some of these other asset classes, bond yields are up a little bit. And what that means is if bond yields are up, bond values are actually down. So it hasn't been a great year for bonds, although with some of those rate cuts that we mentioned, that is a good tailwind for bonds going forward. Energy prices remain elevated. Oil's up about 15% year to date. And then gold has had a heck of a run.
it's crossed its all-time high again, right?
Yeah, it has. It has. And it's up nearly 20% year to date. So gold continues to regularly beat all-time highs.
And it feels like that might be on the back end of some of these interest rate conversations as well.
Yeah.
So of note is the difference here in discrepancy between the S&P and the Dow, and seeing where historically these kind of act in tandem as far as how they tend to measure the overall market performance. And we're seeing a huge delta there, which I think is going to lead us very well into this month's roundtable discussion.
Let's begin today's roundtable discussion with an introduction of our guest panelists today. We are pleased to be joined by Mike Andelman from Dearborn Partners. Mike is a managing director and co-portfolio manager for the Dearborn High and Rising Dividend Strategies. Welcome, Mike.
Thank you. Good to
Looks
be here.
like a beautiful day in downtown Chicago.
It is. It is. We haven't seen many lately, but happy to have the sun out today.
Take them when you get them. Well,
Yep.
We appreciate you jumping on today, Mike, and we'll jump right into it. So it's been an interesting market thus far this year. The top portion of the market, particularly the big tech names, have carried most of the index. The average stock is up more modestly this year, so we have a very top heavy market. What are you seeing in markets so far in 2024?
Yeah, great question. Yeah, we've had a really strong market to start the year. I think a lot of investors, if you met back with them in January, they'd be pretty happy with a full year's return here in 6 months. And yeah, you hit the nail on the head. If you kind of dissect this market, it has been very top heavy, and it's been very tech focused in a lot of the non-dividend paying names, the Nvidias and Amazons of the world. Our focus is on the high quality dividend paying stocks, and they're up this year, and we're pleased. But yes, we're looking at names that are trading at very high valuations that have driven this market higher, and whatever acronym you want to put on it, Magnificent Seven or Eight, the top 10 names in this market, that we look at, they've made up 70 or 80% of the returns of the market. And, there's only 22% of the stocks in the overall market that have outperformed the S&P 500. That's an all-time low. You have to go back to 1998 to see those numbers, and that was the start of the tech bubble. So there is a sense on our investment team that we're kind of looking at call it a mini bubble in certain names, but the rest of the market we feel like is pretty fairly valued here.
And that's kind of where we're at as well, Mike. And I think this slide we're looking at here is pretty illustrative of some of the things we're seeing. If you look at the chart on the left there, the S&P 500 index is up, obviously, but the equally weighted one is up just modestly. And then off to the right, we see the weightings of the largest 7 companies in the S&P 500, and the top 7 stocks in the S&P 500 today account for about 31% of the overall weighting of the index. Highest in recent history. And to your point, Mike, in the past, that's sometimes been a harbinger of a bubble.
And let me maybe just play the dumbest guy in the room here, because I think it's always helpful when people are watching these charts to get a little more, context with it. So when we talk about that, the chart on the left, the black line being the S&P index, that's as it's weighted with every one of those 500 holdings today, right? So one holding could account for a higher percentage of what another holding could account for by way of kind of weighting out the entire index. The blue chart says if every one of the 500 stocks were equally represented in the index, that would be the actual performance. That's a really terrifying reality check, right? When you say, okay, it's not just the S&P index. This is not perhaps an appropriate representation of the market, so to speak. This is a handful of stocks, the Magnificent Seven primarily, that are driving 60+% of the performance of the entire index. And then when you take that and kind of compare it to the chart on the right, which says, okay, when we take those 7 companies and we see what weighting when they get out of balance, what do we see over the last from 1980 till today? And the one that stands out is back in 2000, you see that was significantly out of balance again, clear back then. And what did we see right there? And that peak was the dot-com bubble that popped shortly thereafter. So I think, one of the things that we're looking at, Mike, is are we facing a similar type of formation of a bubble in this market, and what kind of exposure do we have to these Magnificent Seven, saying they're out of balance, and those who have been just in the index not realizing how much of their portfolio is weighted in those 7 positions.
Yeah, right. No, it's a good comparison. I think maybe taking the devil's advocate seat there is, back in the dot-com bubble, you had many stocks that weren't making money. So that's why the bubble was it was really broad-based. It wasn't just tech stocks. It was many names, even some that we hold in our portfolio, that were trading at 40 times earnings, which it's unheard of valuations for a lot of the names that we follow. We look at names that are more in the 15 to 20 times earnings as far as price to earnings ratios go. But there were a lot of those names that weren't making money that we would never focus on. And so that bubble burst. This time around, these are quality companies that are in the tech space, the Nvidias, Apples, Microsofts of the world. They're making money, but the valuations are getting to the point where they're extended. They're being priced, in our opinion, like they're going to be growing 20% a year for the next 5 years. And don't get me wrong, we've had a great period of growth here. We got past COVID. The economy's been strong. We can talk about inflation is now back in control. Now the prospect is for maybe a slowdown. And, the Fed may cut rates here by the end of the year. We just got a CPI number from June that was negative, which was a big surprise to the market. And that means the Fed may have to cut here. They might be taking a victory lap and say, okay, we contained inflation here. But what happens with the slowdown is we may see the employment market weaken and the consumer have some struggles. So you don't want to be buying very high priced stocks when that happens. And we think we might be at an inflection point here in the middle of 2024 here. So the rest of the stocks in the market we don't feel are in bubble territory. And you've got 490 names that are, you mentioned it, are up low single digits. And a lot of those names in the last few weeks after that CPI print, they're actually up nicely. Small and mid cap names, we've got about 30% of our portfolio in mid caps. They're up very nicely here this month, while the rest of these big tech names are rolling over here at this point. So we don't like to make market calls, and this trade has been very long in the tooth, shown by your chart there. That spread between the S&P market weighted versus the equal weighted, that's the largest we've seen since we've been running these portfolios starting in 2011. So there's a number of reasons why we think this might be an inflection point. And again, we're in an election year, and we're keeping a close eye on that. But it's all about interest rates, the economy, and the consumer. And it seems like call it the gravy train might be ending here.
Yeah, and even today, Mike, I mean, we're seeing a little bit of that, right? You look at the Dow, and it's in the black, it's positive, and then the Nasdaq is down significantly, and some of those big tech names are taking a hit. At last glance, Nvidia was down about 6% today, so it does feel like we might be, to your point, in a bit of an inflection point. You look at Nvidia, and it's trading at 75 times earnings, and fabulous company, but at those PE ratios, you just wonder how sustainable that is.
It's hard to make a case, when they're trading at that high multiples. It's tricky. And when we're talking about, the application here isn't just, investment. It's retirement money in many cases for the people on the call with us today. And so we're looking at saying, how do we appropriately diversify? Because it's tempting to chase the hot dot. It's tempting to get out there and say, look what the S&P has done. But the point that we need to emphasize here is a well-diversified portfolio. How do we build a well-diversified portfolio even when the S&P is outweighted?
Yeah, right. And you brought up Nvidia, and we talk about the top 7 or 10 names. To give you an idea, Nvidia is about 5% of the S&P 500 right now, and it's up 130% even with a pullback. So Nvidia itself, just that single stock, has been a quarter of the market return this year. If you didn't own Nvidia in your portfolio, you're behind the S&P 500 by about 5%. I've never seen anything like it in my career. It's to be honest, it's nice to see this pullback. We feel like it's been extended. You can always point to some bubble in the market. Years ago we were talking about Bitcoin, and there always seems to you see a bubble, and we do feel like there's kind of a mini bubble going on, and we may be in the midst of that bursting. But the rest of the market we think is fairly valued. Earnings growth is going to be in the 10% range here this year after earnings were flat last year. So it's not doom and gloom by any means. The companies we research and buy in these portfolios, they do well in good markets and in bad. If the consumer has to pull back, we own stocks where people dine at. They need products from every day. These are consumer staples, healthcare companies. There's a lot of positives in the sectors that we follow and the stocks that we own. And again, earnings growth is back. We had a pullback in 2022 because of fear of a pending recession that never came, and the market pulled back. We felt like it was a bit undervalued at this point. And again, I mentioned we feel like the market is fairly valued as a whole. It's just a very narrow part of the market that looks like it's overvalued here. But earnings growth is here. Dividend growth is solid this year. More than half of the stocks in our portfolio have increased their dividend almost 6%. And that's the overall goal of the portfolio, is to increase your income. And if markets get tough, our stocks typically hold up very well in that type of market, as shown in 2022 when the market was down 19% and this strategy was down around 4%. So, I hope we don't see that type of market. We definitely feel like we're in a better place. But yeah, we really like what we've seen as far as earnings growth and dividend growth goes. We expect every company in the portfolio to increase its dividend this year. And, really starting next week, we really see the bulk of the earnings of the S&P 500. So we'll be watching them closely.
I like some of the things you touched on there, Mike, and I think right now there's cause for caution, yes, but definitely cause for optimism as well. And on the cautious side, that top heavy market definitely gives me some pause. But I think the good news there is if you are well diversified, if you aren't overly concentrated at the top, if we do see that kind of deflating of some of that bubble, you're not going to be as exposed to that. And so I think, as always, the game plan is sticking to fundamentals and having a well-diversified portfolio.
Yeah, and I feel like that's a good case to be made. There's a case to be made. We don't have a crystal ball readily available, but there's a case to be made that says the economy is healthy. And the economy is strong, and these companies that we talked about, Mike, going to eat dinner at and buying our supplies from, these are businesses that are turning profits and are producing earnings and paying dividends. These are good businesses still. We do get the call from time to time from clients saying, "Hey, I worry about reaching these unrealistic points in the index," right? And they're pointing to the S&P saying, "Hey, we've had unprecedented growth in these indexes." And we're saying that doesn't necessarily mean the economy is due for a big reversal, but maybe some of these top-heavy positions that we are talking about are going to have to, come back to reality. And so well-diversified portfolios will tend to fare during those events.
Yeah, right. No, that's exactly right. And, about 20% of the S&P 500 companies don't pay a dividend. So we those aren't in our universe. And it just so happens there's been a couple periods here in the last 3 or 4 years where those names have gone through the roof. And we have, I won't say resist the urge, because we don't buy stocks that don't pay at least a 1% dividend. But so we have to watch those. And sometimes you see bubbles. You got to go back to the tech bubble, and a little bit after COVID, we saw a similar period. But as far as the other 80% of the S&P 500 companies that pay dividends, those are doing quite well fundamentally. It's just the price performance hasn't reflected that, and there's a number of reasons why. But there's a pretty good backdrop why those names should do well here going forward, even with a little slowdown in the economy. And we're not making any recession call at all, because we're going to see close to 10% earnings growth this year out of the market and out of these stocks, and then the forecast for next year is the same. So it's not like we see 1-2% earnings growth, and then if things go south, we're going to see a recession. We just aren't seeing the signs for that at all. The consumer is still strong, wages are up, we're at full employment. The unemployment rate is still very low. So even if there are some type of layoffs here in the fall, we still expect the overall employment market to be strong, because wages have increased dramatically here in the last 3 or 4 years, and that means the consumer and corporations are doing well, and that's really what drives this economy.
I think Warren Buffett said, "Be fearful when others are greedy, and be greedy when others are fearful." And I think the application in this discussion is not chasing the hot dot, but having some conviction to a well-diversified portfolio will tend to fare well.
Yeah, exactly.
Well, very good, Mike. We appreciate you jumping on this segment of our roundtable discussion.
Great to see you guys.
Take care.
Thanks,
have a great
Mike.
week. Bye-bye.
This month, we received a great question in our mailbag. It reads, "I signed up for Medicare Part A when I turned 65 because a coworker told me I'd be penalized if I didn't. I am still employed and have good health coverage and contribute to an HSA. Do I need Medicare now?" Now, this is an interesting question. I'll preface it with Scott and I, we're not Medicare experts per se, but we definitely talk through retirement planning. And this is one that we get regularly. Medicare Part A is not a required coverage if you currently are employed with creditable health coverage. So what that means is if you work with an employer who provides health insurance to you and that health insurance is considered creditable, you are not required to go get your Medicare Part A enrollment when you turn 65. That is widely misunderstood by many people, and I think it's actually done by design. I think a lot of people will market that you'll be penalized permanently if you don't enroll in Medicare, and it's a little bit of a fear tactic. And their goal is to get you to call them, and they can start developing that relationship. So I'd be a little bit cautious about that fear tactic because it's not always accurate. If you do have creditable coverage, you're not required to enroll in Part A. In fact, there are times when you need to be a little bit careful of doing so. In this case, the client asked about an HSA, and if you are enrolled in Part A while currently contributing to an HSA, you could in fact introduce yourself to some additional penalties because you're not supposed to do both, enroll in an HSA and simultaneously be receiving Part A coverage. So I think the takeaway to this question is reach out to our team here at Alliance Wealth. We'll put you in contact with Medicare experts, and they can in fact objectively walk you through how to do that when you turn 65, what your options are, what your requirements are, and how to navigate that minefield.
Yeah, right about the time you hit 64, you start getting inundated with emails and stuff in your mailbox with a lot of those scare tactics, and it's really hard to separate the wheat from the chaff there. And to Paul's point, call us up and we can put you in touch with folks who can help you kind of figure out what's valid and what's not.
That's right. And if you are not working and there's no creditable coverage offered through an employer, you're not working, you do need to sign up for a Part A. And so being aware of those calendar timelines is important. And that's where, a phone call to us will kind of give you the step-by-step process. I want to close out this month's call with a retirement planning tip. And this is one that we field regularly where people in retirement, and I don't know if it's just the kind of clients that we tend to attract, but there's a lot of generosity amongst the people that we work with, and a lot of people that will make charitable giving a part of their regular expenditures and sometimes it can be somewhat significant. $15,000, $20,000 a year oftentimes is donated to charities, and we think that's amazing, and we want to continue to help our clients get the most out of that experience. One of the concerns is with standard deductions being so high, oftentimes people don't receive any kind of a significant tax benefit for giving those charitable issues. I know we don't give into charity for the explicit purpose of receiving a tax benefit, but if we can get a tax benefit when we donate, that's certainly a good thing to do as well. So I want to explain the concept of donating via in-kind donations. So I'm going to draw some pictures here. If we have purchased, let's say, some stocks, and we did that purchase at, let's say, $1,000, and over time, those stocks are now valued, to make our math easy, at $11,000. Okay, that means there would be about a $10,000 unrealized long-term capital gain, and that's assuming we've had that appreciation take place longer than 1 year. Okay. Now, it's not uncommon for people to say, hey, when I make my charitable donations, I do that by writing a check. And as we talked about, that may or may not have any kind of benefit to them. If they're itemizing, then they can deduct that. If they're not itemizing and they're using a standard deduction, then it's below that standard deduction anyway, and there's no additional benefit to that. But if they donate these stock positions that have appreciated in value to their charity of choice, rather than writing a check, two things could happen. The first is there's roughly, on average, 20% capital gain that is required when they sell these positions. So just out of the gates, that would be roughly $2,000 in taxes that if we donated these, we would no longer be responsible to pay. We can donate the entire fair market value of those appreciated stock positions. The charity receives that entire value, and they are not required to pay any tax when they sell those positions. So we save $2,000, the charity saves $2,000. On the second part is if we are itemizing, we then also have the ability to deduct the entire fair market value of the donation. And so think about it in that term, Scott. I mean, that's pretty significant where you can say, okay, let's say I'm in a 24% tax bracket, and I save 24% by itemizing and donating these positions. And in addition, another 20% on capital gains that I am not having to realize. That's like a 44% potential tax savings to make this donation, but via an appreciated stock position rather than just writing a check out of my bank account.
Yeah, and the good news too is you can still retain the stock in the long run. And so what a lot of folks will do is after they gift the stock, the cash that they had earmarked for that donation, they put in their account to purchase the stock back, and you've basically reset your cost basis to that higher level. So you do get to have your cake and eat it too.
Yeah, many people will say, well, I love that stock. I don't want to sell it. That's great. So we keep the stock. We just buy it back at a reset cost basis. If you love the stock and feel that it has future opportunities, great. We'll continue to purchase that stock, but do so with a reset basis so we don't have more gains to deal with in the future. So an awesome opportunity. I think the number one thing I see people here is they'll hear about this, they'll know about it, but they actually get a little bit intimidated by it. And they say, oh, it just feels like a lot of extra work, and I don't want to have to engage all that extra work. It's so much easier to make my charitable donations by writing a check. That's where your team here at Alliance Wealth Advisors comes in. Just reach out to our team here. We can do these transactions with you and for you. You don't have to do all this extra additional work on your end. That's what you've retained our team to help you do. So reach out to us here. We'll talk you through charitable donations and in-kind donations. So we appreciate everyone jumping on the call with us this month. Hopefully it's great content and you guys enjoy it. And until next month, thank you, everybody.
Thanks.